To the orbit. It is Friday, May 10th. We've got stocks unchanged, but it hasn't been completely uneventful. We didn't open here and just go sideways. We actually gapped higher this morning. Not much of a gap, but a gap nonetheless, about in line with the expected move for the day. Found sellers, and now we are back to basically yesterday's close right here. This has been a sleepy, slow grind higher for the last couple of days in the market. You can see that action yesterday. Not too many red candles for the entire week. And when we do, those have found buyers. We are getting to testing levels this morning back towards the prior high, and fell just short of that. That's up closer to 52.60. Let's say we got up into the 52.30s today, almost 52.40 before finding some sellers. The expected move the rest of the day is about 0.3%. That is 15.5 IV. You can see that in the top right corner. That's, again, very low short duration implied volatility, producing expected moves coming into the day at about 0.4%, under 0.5%, and quickly finding expected moves, down towards 0.25%. So for those that are zero DTE trading, credit spread traders, again, you have to be careful about how tight those break evens are. If you find yourself where it wouldn't take much more than a 15-point move in either direction, and right now we are looking at basically a 16-point expected move. So you have to be careful about those levels and of your short strikes, perhaps going a little bit outside that. Now, obviously, you're giving up premium collected for that, but in a slow, lazy market, the worst thing you can have, and it's the type of thing that can happen on days like this week, is where you get that slow creep higher, and that slow creep higher might turn into a 20-point rally on the day. So you have to be careful there. Go and potentially be timing these types of moves. So when you have that gap higher this morning, perhaps that's the time to put on a credit call spread. And what you're doing is you're essentially positioning for that kind of heavy gamma type trading, where stocks making moves higher in the morning might find sellers. If we went red here, perhaps down to 5,200 level, you might have a gamma wall the other way where buyers emerge, and perhaps that's a time to do a credit put spread below that level. As we've been saying, we've got the CPI next week, and there's a bit of an uptick in vol for next week, and that comes Wednesday morning, and you can see that here, but it's not a ton of IV. So the options market as of now is not expecting fireworks for CPI, or at least not pricing them in yet. Now that might change on Tuesday, for instance, where options start to tick up a little bit to incorporate, and that you would really see that. You would see that less in the VIX, because the VIX is far out, 30-day window out into the future. Where you would see it is you might see Wednesday zero DTE IV, instead of being 16, you might see that up towards 30 to incorporate a bigger expected move on a CPI print, which instead of 0.4% coming into the day, it might be 0.6, 0.7% coming into that day. So be aware of that if you're rolling trades, if you're looking out a week. And again, as we've been mentioning, going into SPY, Qs, individual stocks, some of these big cap tech names, when you go to that 1 month chart, this is low IV across the board. So traders and investors that are positioning directionally, perhaps for a breakout here, perhaps for a failure at these prior highs, put spreads are inexpensive, call spreads are inexpensive, calls and puts are inexpensive, and you could potentially leg into a put spread, like buying a put, seeing the market come down a couple of percent, and then selling a put against it. But we are loaded with gamma. The options market is not anticipating the type of volatility that we saw over the last couple of weeks, over this, basically in April. It is not anticipating that anytime soon. Is the CPI enough to change that, change the mood of the market? We will see. But if the CPI comes in sort of Goldilocks, or not shocking in either direction, this is a market very loaded with gamma, which might potentially turn a 13 VIX into the type of VIX that's bouncing between 13 and 15 If CPI comes in really hot and the whole narrative of the last 2 weeks changes, that's when you would see the VIX spike back up to 16. You would be selling off on the market. You would be maybe potentially testing those lows, but that would probably take a very hot CPI at this moment and some worried Fed speak, for instance, which is what we were seeing last month during all of that volatility. But for now, it is an extremely low IV market, extremely low VIX, extremely low short duration vol, and a very subdued market as of now, which is good for options premium sellers in that you will not see the realized moves in most cases. Sellers are selling low IV and they need to be aware of those low IV levels, and they perhaps have to be a little bit more deliberate with their timing of those sales. As far as premium buyers go, the options market is not anticipating big moves anytime soon. So your duration, when you are seeing a low VIX, your eyes should go out farther on this chart, out towards buying yourself time, that if we do go through a very low period of a slow creep higher or sideways action in the market, that you are not wasting away theta every week trying to anticipate the change, the exact time that changes. One thing to be considering is going out in time and buying time for that next move. You are not being penalized for it. You will see very close break evens going out even a couple of months on a call spread to the upside or a put spread to the downside.